Hello, everyone. Welcome to episode 1 of Leon's Finance Show, where I document my investing journey and just key lessons I've learned along the way so you can walk away a more informed decision maker when it comes to finance and money. Now, today being the first episode, I want to talk about why I'm so interested in investing. Specifically, I'm interested in finding value stocks that are also dividend stocks. And I've come to this conclusion really after 2 years of investing, of testing the waters. I want to share with you my investing journey thus far and really why you should be paying attention to the yield curve right now. And I guess the format of these videos will be once a week. It will include a portfolio update, new stocks that I come across, and me analyzing news that matter to investors, as well as just me giving my 2 cents on, well, pretty much everything under the sun. So what you have in front of you right now is actually my portfolio performance over the last year and a half or so. So February 2018 to October 2019. This is a list of the stocks or funds that I've bought bought and sold. And so you notice that my total gain lost $12,174 in the last year and a half. During the same year and a half, I made just over $3,000 in dividends. So that adds up to about $15,000. And the money that I used to make this $15,000 is my tax-free savings account. I live in Canada, and in Canada you can have a tax-free savings account where all the money you make within that account is not taxed at all. So that's really cool. My tax-free savings account right now is maxed out, and I believe the max amount, if I go over here, you'll see the max amount. This is the government website, by the way. So the max amount right now, if I add all of these numbers together, is about $63,500. Okay, so I want to talk about how I even saved $63,500 before I talk about how I invested and got this result by October 16th. Remember, these are only stocks that I've sold, and so this is a little bit different from my current portfolio because you can see that I have stocks that I haven't sold that have also gained money over here. So $63,500 is a part of what I've saved up over the last 4 years teaching overseas. I'm a teacher overseas. That's my job, and I don't make over $100,000 a year. I don't even make over $80,000 a year at my job. But each year in the last 4 years, I've managed to save somewhere in the ballpark between $25,000 to $35,000, just being frugal and staying home and not really going out, and just being super interested in YouTube and in analyzing companies. So that's kind of been my life in the last 3.5 years. I've been working full time. This is my 4th year, currently 27 years old. So you're probably curious on why I actually am making this. I just want to make it clear. I actually haven't been giving as much care as I should to my portfolios, to my stock investments. And I'm just right now starting to take investing a little bit more seriously, which is why I'm doing this. And I've moved to a more value dividend stock approach because I've had the whole emotional roller coaster of having windfall income. So if you notice this stock right here, IQ, this is actually a streaming app in China. It's kind of like Netflix, but for China. And back in the day, it just had an IPO a few months back when I first bought the stock. And within 2 weeks, I made just under $9,000, and I sold it. But what that experience taught me was however fast something goes up, it comes down just as fast, because a little 2 weeks 2 weeks after I've sold that stock, it went down. Okay, it went down, and I would have lost money. And at that time, I put about $50,000 into the stock, and so it was a hefty amount of money. I don't know what I was thinking, but I've since adopted a more reliable approach. So without further ado, let's go and see what's in my portfolio today. Alright, so I've clicked into my holdings. You can see that this is my current portfolio. It has 5 stocks. Now, I'm not a fan of too much diversification. I think it's too much to manage. Now, I do have a finance degree, and in finance, we're taught to diversify away firm-specific risk, in other words, alpha. But I do also follow the teachings of Warren Buffett, and he does say that diversification is just a way to hedge against ignorance. It's a way for you to do average, and I don't want to do average. If I did, I would just have invested in an index fund that follows the market, and I would have done average, which is okay. But here, this is my attempt to beating the market as often as possible, and just learning more about business and companies in general. So you'll see here, I'm a really big fan of utilities, and so here you see BCE. This is BC Hydro as the website loads, and you'll see that this is Canadian Utilities, which has gone up, and you'll also see Enbridge, which has gone down since its peak. I bought it actually in May. Actually, I bought all of these stocks in May. Okay, so this is my gain, my $3,843. That's actually been my gain since May, and I've also got a little bit of dividends from there as well. So you can see that right now I've got $83,000 in this portfolio. If you include the cash, it's about $83,000. And so I've made just under $20,000 in the last year or and a half or so. Okay, so that's about a 13% return compounded. And I've made that mostly from my windfall income, but I want to switch to a more dividend approach, as I mentioned. So why do I actually want to switch to a more dividend approach? I get asked that a lot. Right now, these stocks pay an average of just over 5% in dividends, which I think is really good for dividend stocks. Disclaimer, this is not my only portfolio. I've got another portfolio in a non-registered account, and I've also got just one stock in my RSP. But for this channel, I really want to focus on this portfolio for now. Alright, so let's talk about why I actually like dividend stocks so much. And dividend stocks are stocks that pay a dividend, which means when you buy the stock, for every share you own, you will get a portion of the profits back, either monthly, quarterly, usually quarterly, but I also have some monthly dividend stocks as well. And this money is usually paid from their profits back to you, because the only reason they would do that is because they don't need the money to grow the business anymore. And what that means is, generally, dividend stock companies that pay dividends, they are mature, cash flowing companies. Okay, so I really like generally that they're companies with a positive cash flow. They've been in business for a long time, so they're mature in that sense. I also like dividend stocks because they provide cash flow. Right? Traditionally, if you invest in growth stocks, you're actually just betting that you're buying in at a good price, and the stock will grow, and once it grows, you'll sell it, and that's how you make money. For me, I'm more interested in finding businesses that I can hold for the long term. That pays me a dividend, because that's kind of the way that I can get income from my investments. Otherwise, I'd have to sell if I want to make money, right? And then I have to go into timing the stock, knowing when it's overpriced, underpriced, and all of that. And I'd rather much just sit there and receive cash regularly. And the third reason why I like dividend stocks is because they're somewhat recession proof. Recession proof. And what do I mean by that? If a stock does not pay a dividend when it goes down in value, technically you don't lose any money until you actually sell the stock. Same thing with a dividend stock. But what happens is I actually have all my investment accounts in a DRIP plan. So that's a dividend reinvestment plan, a DRIP, dividend reinvestment plan. And so what happens is every dividend that I get paid every month goes back to buying more of that same stock. And so what happens in a recession is the stock prices go down, but the dividend, assuming the company is cash flowing and they're not borrowing money to pay for their dividends or doing some wacky stuff like that, they're going to hold their dividends, right? And I'm going to get a dividend, and I'm going to use that dividend automatically to buy the stock at a lower price, because we're in a recessionary environment. And so that's what I like about that, is I actually get to buy the stock at a lower price, which will pay the same dividend that I've been getting. So I get more shares. More shares means more dividends. So dividend stocks are somewhat recession proof. That's what I like about them as well. So with that in mind, then the last day I came across an article about dividend stocks, and here's the article, right? Bank of America declares the end of the 60-40 standard portfolio. So what used to happen was, the recommendation in general was that investors should carry 60% of their holdings in equities or stocks and 40% in bonds. But really, to summarize this article, the asset classes have changed so much that investors now buy equities not for future growth, but for current income, and buy bonds to participate in price rallies. So what this article by Bank of America is saying, it's saying that people now buy bonds like their growth stocks, and they buy stocks like their bonds to rely on the dividend that is coming. Okay, so what's happening right now is people think there's a recession that's coming within the next few years. And so what's happening is people is putting their money into bonds, so record bond outflows, record equity outflows. And what this does is it drives up the prices of bonds. And bonds, like any asset class, has a market, and when more people come to buy it, the demand for it goes up and the price for it goes up. Now, bonds also have a yield, okay? And so the yield is the interest rate that is on the bond that gets paid to you when you buy it, the coupon, right? And so what happens when bond prices go up and the yield percentage doesn't change? It's the yield of the bond ends up decreasing. And the reason is because the interest payments don't change, but the bond got more expensive. So the actual yield you get on the bond goes down. The yield goes down. And so this article actually compares bond yields to dividend yields to bond yields, and it says that a lot of people are now investing instead of in bonds in dividend stocks, which is actually something that I'm doing right now. Now, it's super interesting because 50 years ago, bonds and stocks moved together. Bonds and stocks moved together 50 years ago. It wasn't until 1995 that bonds and stocks had a negative price correlation. That is, they became hedges against each other. That is, when stock prices went up, bond prices would go down. When bond prices went up, stock prices would go down. And so they were a hedge for each other that gave you a less risky portfolio. But before that, like in the 1940s, 1970s, and 80s, they actually moved together, right? They were positively correlated. In other words, when bonds got more expensive, stocks also got more expensive. And here you see a reversion to that, right? So we see kind of like a hill there. And so this article also says that in the foreseeable future, there might be a positive correlation with bonds and stocks once again, which means that there's really no reason for you to buy stocks when there are, buy bonds when there are dividend stocks that really pay much better than the current bond yields. Okay, so this is just what the article is saying right now. That's another reason why I'm so interested in dividend stock. Now, on the topic of bond yield, if you know a guy by the name of Ken Fisher, he wrote a book called Contrarian in Investing. He wrote a book on contrarian investing, and he's a world famous contrarian investor, has his own finance firm. And he says that there are two indicators of an upcoming recession, just two, the leading economic index and also the yield curve. So what I'm about to show you is the yield curve. All right. So what I have in front of you is the yield curve. We talked about bond yields a while ago in the article, but I want to show you the effect of increasing bond prices that cause a decrease in the yield of long-term bonds. So if we take the yield of long-term bonds and we minus the long-term yield with the short-term yield, I get a number. And sometimes that number goes negative. You see right here, it went negative. So in May, it went negative, and it just came back up. And so what that means is people have more incentive to invest in short-term bonds than they do to invest in long-term bonds. So people have more incentive to invest in the short term and less incentive to invest in the long term. Now, what's interesting about this metric is that before every major recession, there has been a period of time that the yield curve has inverted, that this is a negative number. You'll see this is 06, 07, and we all know what happened in 08, right? The financial crisis. Same thing here, right? This was 2000, right? 2000, right here, 2000. What happened in 2001, right? Y2K, another financial crisis. This was the 1989, right? So historically, it's been 22 months within the yield curve inverting. There has been a recession. Okay, so that's super interesting because this just went negative, which provides me all the reason more to have a portfolio of more defensive holdings, including dividend stocks. So moving on to the leading economic index. And what the leading economic index, it's a number that indicates whether the economy is expanding or contracting. So you'll notice here, Conference Board leading economic index for the US was unchanged in August, following a 0.4% increase in July and low change in June. Okay, so you notice here that it's becoming flat. The leading economic index is becoming flat, and it would be a good time to pay attention to the leading economic index, because if it goes negative once, and then twice, and then for a third month, that's saying something about the economy. So right now the economy is slow but still expanding. There will come a point when it contracts, and that's usually a leading sign, right? That's what the leading economic indicator means. It's a leading sign that the economy will go into some sort of a recession. If you scroll down here, you'll get to see kind of the 10 components of the leading economic index. Okay, includes how many hours are there in manufacturing, how many claims are there for unemployment insurance, new orders, how many buildings are being built, stock prices, credit index, and here it is, the interest rate spread, the yield curve that we just talked about, and 10-year treasury bonds, less federal funds, or also less 3-month constant treasury. Okay, so what does that mean? What are my goals for the next 5 years? So I know that there is a recession on the horizon, and so what I want is a portfolio of companies that pay a steady and regular dividend, that have steady and regular cash flows that can weather recessions. And usually these are going to be mature companies that have been paying dividends for a long period of time. But at the same time, I'm also going to be looking for underpriced companies that come across my way once in a while in kind of probably the small to mid cap area. I'll be looking at stocks there, and I'll probably make videos on how I actually go into the financial reports of a company and analyze the stock. More on that later. I found some pretty interesting companies that I think are worth looking at and sharing. Okay, so that's kind of been me. I'm just a teacher, a business teacher with a degree in accounting and finance that's super interested in investing, that has now decided to pay really more attention to my own stock portfolio and to document this journey of trying to create a portfolio that can hopefully pay me dividends that can eventually, in many years later, maybe replace my working income. It's not to say I won't still work. I love my job, but I think this is a good hobby to have. So if you have any questions or comments, please leave them down below. I would love to hear from you and answer some of your questions. Maybe there's something you want me to talk about. I would love to hear from you. And as always, please remember to subscribe to the channel and like the video for that YouTube algorithm. It would just mean the world to me to have you as a part of this journey to financial independence, to FIRE. All right. So hope you have a wonderful day, and I'll see you next time.